Welcome to another chart of the week. This week we're looking at the global equity risk premium. So this is a very important chart for global equities. Despite some reduction in the level of valuations, for instance the PE ratios have fallen, the issue is that bond yields have gone up as well, so the equity risk premium has not really improved. For instance, compare and contrast on this chart the current levels of the ERP or equity risk premium versus that seen during the peak of the pandemic panic or the 2008 financial crisis. Current levels are simply not compelling, certainly not compared to those episodes. The ERP or equity risk premium works well as a key input for asset allocation, for instance by giving buy signals when it spikes, so just to be clear, the higher the better for this indicator, because it reflects outright valuations, but also valuations relative to the risk-free alternative. So just for clarity there, the ERP looks at the earnings yield minus bond yields, basically. There's a few different ways to calculate it, but that's the main way. And indirectly, it also captures sort of sentiment effects and monetary conditions, just due to the change in level of bond yields. So the lower bond yields are, and certainly if bond yields dive lower, that means that a lot of investors are chasing after bonds as a safe haven. It also means that lower bond yields means lower borrowing costs, and that tends to stimulate growth. But simply put, the higher the equity risk premium, the better compensation you are getting for being in risky assets versus safe assets. So clearly, also, then, a lower equity risk premium means less compensation for risk, and hence a riskier setup overall, all else equal, when the equity risk premium is lower, or lower than usual even. So the key takeaway from all this is that the current level of the equity risk premium is not particularly attractive for US equities, and even for the rest of the world, so developed and emerging economies there. While boasting a higher equity risk premium versus the USA, still haven't moved up to those previous major buying opportunity levels at this point. So hence again, we're seeing another indicator that's basically saying not yet for global equities. So the key point there is global equity risk premiums have not improved much since the onset of the bear market, which in other words means that there's probably still some ways to go yet before all of this is over. So if you like this chart, this presentation, be sure to subscribe to the channel, but definitely also subscribe to the free chart of the week so that you can get that sent straight to your email inbox.